Tired of watching your money disappear? You're in the right place, let's save it. Hey savers, welcome to Save It, where we make your money work harder. Please remember this video is for entertainment purposes only and is not financial advice. Today, we're diving into a super interesting new tax change that could put some serious money back in your pocket. Deducting interest on personal car loans. You heard that right? If you've been watching the news, you might have caught wind of the new One Big Beautiful Bill that just passed. This sweeping tax and spending package has a lot of moving parts, but one provision that's getting a lot of attention is this brand new deduction for auto loan interest. Now, traditionally, interest on personal car loans hasn't been tax deductible for most people. Business owners, yes, but for the average consumer, nope. But that's changing for a temporary period. This deduction is temporary, set to be available for tax years 2025 through 2028. So, it's not forever, but it's a fantastic window of opportunity to save some cash. So, how does it work? And more importantly, do you qualify? Let's break it down. First off, this deduction is aimed at personal car loans, not business ones. So, if your car is primarily for getting around town, commuting, and family errands, this could apply to you. US assembled vehicles only. This is a big one. The vehicle must have had its final assembly in the United States. This means that many popular imports, even from major brands, might not qualify. So, before you get too excited, do your homework on where your car was actually put together. This is a deliberate move by lawmakers to incentivize buying American-made cars. Loan taken after December 31st, 2024. The loan itself needs to be taken out after the end of 2024. If you bought your car and took out the loan last year or earlier, unfortunately, this new deduction likely won't apply to that existing loan. Income limitations. There are income phase-outs. For single filers, the deduction begins to taper off if your adjusted gross income exceeds $100,000. For married couples filing jointly, the phase-out starts at $200,000 AGI. The deduction is reduced by $200 for every $1,000 of AGI over these thresholds. This means higher income households will see less benefit, or no benefit at all, if they're well above these limits. Deduction limit. You can deduct up to $10,000 in interest paid on a qualifying auto loan per year. Now, it's worth noting that to claim the full $10,000, you'd generally need a pretty high car loan amount, probably in the six-figure range, given typical interest rates. But even for average car loans, this could translate into hundreds of dollars in tax savings annually. For example, on a $40,000 car loan with average interest rates, you could potentially save around $500 in the first year alone. That's real money. Another great thing about this deduction is that it's an above-the-line deduction. What does that mean for you? It means you can claim this deduction even if you take the standard deduction on your taxes. You don't have to itemize your deductions to benefit, which is a huge win for most taxpayers. So, how do you actually claim it? While the bill is passed, we're still waiting for the official IRS guidance on the exact forms and procedures. However, what we know is you'll need to keep good records of your car loan interest payments. Your loan provider should send you a statement at the end of the year detailing the interest paid, similar to how mortgage interest is reported. Now, on a related note about car buying and tax credits, there's another important update you need to know about. Based on the latest information, the federal EV tax credit for new electric vehicles, up to $7,500, and used EVs up to $4,000, is set to expire on September 30th, 2025. This is a significant change, as these credits have been a big incentive for many people to go electric. If you've been considering an EV and want to take advantage of that credit, you'll need to act fast before that deadline hits. This tax-deductible car loan interest is a significant change designed to ease the financial burden on middle-class households, especially with car prices and interest rates being higher than usual. It also encourages the purchase of vehicles assembled right here in the US. Important reminder: tax laws can be complex and are always subject to change. While I'm giving you the best information available right now, it's crucial to consult with a qualified tax professional for personalized advice, especially as the official IRS guidance is released. They can help you determine your exact eligibility and ensure you're maximizing your savings. Also remember that this new car loan interest deduction is temporary, currently set to run through 2028, so plan accordingly. So, if you're in the market for a new car, or even if you just bought one that qualifies, make sure you keep this potential tax deduction in mind. It could be a nice little bonus come tax season. And if an EV is on your mind, remember that September 30th deadline. What are your thoughts on this new car loan interest deduction or the expiring EV credit? Let me know in the comments below. That's our wrap-up on making your money go further. Please give this video a thumbs up, subscribe to the channel so you don't miss out on more ways to save it, and share it with a friend who may benefit from it.